So before I get going, in this video, my intention is to talk about whether swing trading is really still worthwhile, especially in the currency markets. I do think it's very suitable in other markets, but seasoned traders, friends of mine, colleagues, people I've known for years, we've been having this discussion for a while, for the last couple of years, and we're just kind of not really feeling that it's the same as it used to be. Okay, so let me give you some quick background into myself. This is actually my second career. I founded a company, post-production company with my best friend in South Africa at the time, and sold my shares in that. I sold, and I wanted to change my life, and this I did about 2008. Sold my half, moved overseas, and decided to I wanted to learn how to trade stocks, but at the time everyone was talking about Forex, and so I ended up spending a lot of money on some mediocre education, but it got me started, introduced me to trade with precision, introduced me to trend-based pure technical trading, and I think it was at that point that I started to become more consistent. Then I started trading for obviously my own capital as well, and then I started trading for clients, and then for regulated funds in the UK. I'm a technical trend trader, which means that I prefer trending markets. I think that's the best way to trade. I'm still not convinced. I'm open to being convinced. The data, and I've looked at everything I've worked with a lot of different people. Trend-based trading seems to be the best way for the average person to trade the markets. And of course, obviously, I'm got a couple of books on the go. I speak at a couple of events. I enjoy that because trading doesn't necessarily take that long. All my trades, for example, today is Friday. All my trades are done. I've got a couple that are open where I'm just trailing the stop. It's been some really good dollar weakness, so really big moves on some of the majors. So it's been relatively easy trading today by comparison. Okay, so what I wanted to do here is kind of talk about how the markets have changed from when I got started. So in 2008, 2009, there was a thing called the carry trade, and a carry trade was really when institutions, for example, with the interest rates that were different between the different countries, so Japan, Bank of Japan, Central Bank of New Zealand, or the US or whatever, had different interest rates. And so you could, if the interest rate was low, you could borrow money from them, and then if the interest rates in another country was high, you could lend to them. And so there would be what's called a carry trade, which resulted in particular pairs, Euro Yen, Euro Swissy, actually quite a few of those, where there were these kind of long, steady, beautiful trends. There's just this really nice rhythm to the market that was just almost bulletproof. It was so easy to trade by comparison and really worthwhile back then. But where we are today is that a lot of those same major banks, central banks, have all reduced their interest rates, and so the carry trade doesn't really exist in the same way, and it's not as appealing to big institutions or big funds anymore. And so I want to talk about what the markets are looking like now and whether it is worthwhile still doing swing trading. And so before we kind of go any further, let's have a look. Let's kind of define what swing trading is. Okay, so this is taken from Wikipedia. I'll leave the link if you care. I'm a supporter of Wikipedia anyway, but I'll leave the link below. Investopedia, Baby Pips, there's a lot of really good places to get it. But the definition, according to Wikipedia, and I've amended it, is swing trading is a speculative trading strategy in the financial markets where a tradable asset is held for one or more days. And I've scratched out in an effort to profit from price changes or swings, to change it to as a way of profiting from price changes or swings. So they've said in an effort to, as though you're trying but you can't really succeed, kind of thing. And it's not actually the case. It is definitely done. The question is it still worthwhile? Is it still profitable to do it today? So we talk about the highs and lows, swing highs and swing lows. So these turning points on the bottom of a chart, these little turning points here, we refer to those as swing lows. The swing highs are what we refer to at the top. But here's the thing. What they don't tell you when they do this is that what you should do if you're smart, predominantly, or if you're lower risk, if you want a high probability, a high rate of success, high probability of success, you want to be trading ideally a trending market. First of all, a trending market, and really then you really only want to be focusing on the lows. So in other words, you're not going to be swing trading both sides of it. You're not going to be counter trend trading that. So, there are traders who do it. There are traders who sell, try to determine the top, sell at the top, and then buy at the bottom. But in a really strong trend, the best thing to do is to just be a buyer in that trend. So once you've got a trend, as in this example that I have on the screen, is that you would really be looking mainly for, and not just to get in once and ride it out, because as a trader, you don't really get paid until you kind of, at the end of the month, you've got to have money in your account, you've got to close out those trades. And so as a trader, you're looking for a shorter term, immediate move, and then you're going to close out the position. So you're not looking, an investor is looking to hold those positions for a very long period of time. A trader is looking for a singular move, ideally to capture some profits, and usually it's at a ratio of 2 to 1 or 3 to 1, meaning that if they risk 1% of their capital, which is obviously very common and very sensible, that they would capture ideally 2 or 3 times that amount in terms of profit, because not every attempt to capture a move is going to result in profits. So swing lows would be the targets in an uptrend, and swing highs would be the opportunities to sell in a downtrend. And this is today, so this is really about Forex. Like, is it worthwhile doing it in Forex? Now, the next thing that we need to take away from this is that predominantly swing trading refers to trading the daily time frame. That is the standard kind of internationally accepted, most, kind of preferred time frame to look for trading opportunities. But these days, you could argue that it's worthwhile looking at that on the 4-hour time frame or potentially on the weekly. Sometimes you get a really good inch candle on the weekly and it's the same size or better than you get on the daily. So let's go to the charts and let me walk you through this, and let's take it a little bit further. Okay, so what I'm going to be doing here is I'm going to be doing kind of manual back testing, where I'm going to demonstrate, I'm going to take you through. I've actually gone back to January this year. So this is 2021, and I'm going to quickly show you a couple of things with the charts, and then I'm going to explain what it is that I'm doing here to show you kind of whether it's worthwhile. So first of all, let's go and have a look at Euro Yen. Okay, so Euro Yen, this is a daily chart. So for now, all we're going to be doing is looking at the daily charts. And really, when we get situations like this where the trend is not really going anywhere, it's incredibly volatile, that's not really ideal. But I want to show you that if you go back over time, let's just say if I can go back and say, let's capture 10 years. I'm using Pro Real Time. If anyone's interested, I like Pro Real Time. It's a great platform. It's not a broker, it's just a platform. But I want you to see here, if we go back, especially 2000, okay, we've got a lot more than that. So let's go back even here to kind of when I was getting involved. But you can see you can have very, very years worth, almost a decade's worth of trending to one side, continue down. So you can actually say that you had a downtrend going from 1980 to 2000, which is 20 years worth of downtrending. And then if you kind of look at where it is now, not really going anywhere. So it has changed. There's no doubt that it has changed. Look, to be fair, retail traders didn't really get access to the currency market, although it was available to exclusives kind of in the 80s. It wasn't really available to people like you and me, the retail traders, around 96, 97. Okay, but even then, Euro Yen, Euro Swissy, there was some amazing longer term trends, just really steady, before they actually had to intervene. This is the SNB, Swiss National Bank, had to intervene. There was some just really good periods of just beautiful, long, sustained trends, just incredible. Okay, and so that was very attractive for traders. It's not really the way it is today. So that's part of what's changed in the look of the charts. But if we now are going to have a look, we'll start off with euro dollar, and this is actually an exercise that I recommend that everybody. This is a monthly chart. That's part of the reason why we have this kind of issue. Let's go back to this and let's have a look at this. Okay, so on the daily chart, this is what I've done. I've gone back to January, and I am using, now I'm using more master trader techniques where there's a break of support resistance level, and these will be in other videos that I'll produce, but a support and retest. This is simple, the most basic of technical analysis, which is the most reliable stuff, believe it or not. It's like a break of support here and then a retest. So I've gone back to December. There was an uptrend in place. There was a beautiful real break of resistance. Come back, retest it. If you're a confident trader, you would have seen these as buying opportunities. So it was a move up. Remember that we're not looking to, we're not investors, we're traders. So we're looking, if my entry is here, my stop loss is here, I'm looking to take profit at 1 to 1 or 2 to 1. Okay, so this one absolutely would have been profitable. You either would have been stopped out here. If you trailed your stop, you might have been stopped out here, depending on how you would have managed that trade, which varies by trader. Then we break below that. So we break this trend. So now what actually happens is this last one, if you took this as a flat level breakout, so if you saw that as a flat level breakout, that would have been a losing trade. Fine, so be it. Okay, next price comes down, breaks the lows here. It's a break if you took that as a flat level breakout to the downside in this area, you would have made some money on that, potentially break even, captured some profit there, because most traders will take some money off the table and try to get their stop loss to break even, or try to capture some profits and then protect the rest. Then it comes back up and it retests this. This becomes a shorting opportunity. So that's profitable. This one is profitable, pulls back. There's actually a break below here. That's another entry opportunity. So you can do that. But this is hard work. It wasn't always like this. You could simply have just waited for price to pull back, got in. Even here, there's a flat level breakout. So there's money making opportunities. And this is just euro dollar, mind you. So there's some profitable ones. Price comes back up. That actually becomes another shorting opportunity, which is okay. I mean, they're not really huge. Here's another retest of this level. Solid rejection. That one is incredibly profitable. And there's actually another entry opportunity here as a sell signal, but also a flat level breakout. So the more experienced traders who are looking at this will know exactly what I'm talking about. Okay, you'll be like, oh yeah, that's a nice bearish candle. That's a flat level breakout. Price breaks through. And by the way, I'm restricting this to only getting in on the daily. So you're not allowed to cheat and go down to the 1 hour and look for an entry on the 1 hour following the daily. We're not doing that. For today, you're only allowed to find entries off the daily and get in on this. So then we have price pullback. There's potentially another sell opportunity here, which is okay. There's another one here, which is a losing trade. Price comes back up. There's another rejection here, which some traders might have taken. And there's another move down here. So these are different types of signals. And then as you get more and more experienced, your brain is capable of, your brain is quite capable of seeing the market from multiple angles. So you don't just have one type of pattern that you can use. You have 3 or 4 or 5 different types of patterns that you can get in. Price comes down, that would have been captured, that would have been a nice profitable trade. So out of all of these, there were probably quite a few 1-to-1s, a couple of losing trades, then there were a few 1.5-to-1s or 2-to-1s, and then there was a couple of 3-to-1s or 4-to-1s. And what you want actually is 3-to-1s, meaning that for every 1% you risk, the market is ideally allowing you to capture up to 3% of that move. Here's a flat level breakout. Boom. Very nice. There's another flat level breakout here. These are just, I hope you could see this. I hope that as I'm explaining it makes sense to you. You've got a flat level here from these 3 candles here, and you've got a breakout candle. Okay, so breakout of that. Here you've got a flat level breakout. This one is a little bit easier because you've got high lows going into it, so your stop loss is tighter. I will, if you want me to go into more detail on those things, let me know in the comment section, and I will, because obviously the idea is to start to talk about that. So there's a couple of entry opportunities here, another flat level breakout, another flat level breakout. Yeah, you're going to move, which could be a potential swing low to the upside. Here's another move, swing low to the upside. Then you just hit this kind of mess over here. There's a potential flat level breakout, which is a failed trade. So all of these are profitable. There's a losing trade. Then we start to come down. We start to break these lows. We've got a lower high, lower low. So that momentum is shifting to the downside. Here we get a really nice sell signal. That's a really nice move to the downside. There's also here a pullback and then a flat level breakout to that side. And then we've got some more sell signals here and a couple more here. So actually here you can even see a couple of levels of resistance. They're okay, they get a little bit messy. You get another pullback up to that level. So there's another pullback up to this level with some really strong sell signals here to go down to the downside. So actually not bad, relatively profitable on that. Similar to this type of a behavior where you get multiple rejections at a level and then it kind of ultimately goes. It's called market structure. Here we can see that it's supposed to be respecting that market structure. And even here, there's a couple here, for example. This is a really, really, really nice flat level breakout in a downtrend. Nice little flat level breakouts and a move and then a break and a retest and a continuation. Then it comes back, retest it again. This would have been bad whichever way you got in. If you'd sold here, you would have been stopped out there. If you tried that as a breakout north, you would have been stopped out there. Then it kind of calms down and ultimately actually resumes the trade to the downside. But that would have cost everyone something. Continues down, and this is where we are today. So the market's been range bound where it is now. It's within the range. My expectation is, we'll see how this goes. My expectation is if we can break out with a nice fully bullish candle closing near this level, then we are likely to head up to this level. And so that over the last year, and actually what I'm going to do is I'm going to pause the video and I'm going to go and highlight as many of the trades as I can see so that we can really get a sense of it, and then I can kind of give you a wrap up of the data. and then we can see actually how it was going. But what I would say is that this time, I think that it's just a lot of hard work. I think it is feasible, but you have to be prepared to kind of try to capture one-to-ones. You have to, basically the moves are not necessarily as sustained. So where before you could have had quite a tight stop loss, 5 pip trailing stop loss behind your daily candle, what you have to do today is either you capture your profit sooner and get out, or you need a much, much wider stop and a lot more patience, and you have to let it run. Myself, from experience, I'm thinking probably the best would be to do shorter moves to the downside. That way you're not finding yourself being charged overnight fees on a trade that you could be waiting on 3 weeks for before it ultimately goes in your favor. It's just not really worthwhile. You'd rather just get in, and then if there's no trade, there's no trade. So that's kind of where I am, at least at the moment, with my end of day trading. Intraday and day trading has been amazing lately. I'm finding day trading on currencies phenomenal. It's really been incredibly profitable. So, okay, let me pause this. We'll come back, and I'll just mark all these, and then I'll give you the stats on that. And that'll just be euro dollar. Okay. Okay, so all right, so after spending some time on this, there's a couple of things that have basically happened. I want to go through this in more detail now. So even though I've already done it, I'm going to slow down. I'm going to go through each of these now, which is going to take about, let's say, 15 minutes. And I would recommend, if you really are interested, that you go through it with me. It's not a lot of time, and you'll learn a lot from it. However, for whatever reason you're impatient and you want to jump to the stats, the end results, then you can do that. The chapter link will be below, and you can just go to the stats at the end. But actually, the whole point of watching this video is really to see what the opportunities were. So I'm going to go through this a little bit slower and actually walk through it. Okay, so basically the reason I started this one here, because effectively January is kind of only there. All right, but I started with this because it was a year from when I was going to record the video, therefore it's December through till December. So what I've done is I've essentially broken trades down because they're different trading styles. And first of all, disclaimer, when it comes to the stats and when it comes to these trade setups, I'm going to be 90%, 90% of all traders will agree with me. There'll be a few that might dispute a few things. Absolutely, I'm open to that. But the point of this was to give a general overview of the general performance of the euro dollar as an example. And let me explain why. Because if you're going to nitpick as to how you go about doing stuff, then you might have a variation on the results, but it won't negate the overall sort of consensus or like conclusion. So, okay, so first of all, I talk about a candle signal, meaning an individual candle or series of candles that are themselves actual entry signals that traders will identify. So that's the first thing. The second thing is that I define them as profitable if I can see that clearly the market has moved in that favor, which means it could be 1R or 2R in terms of potential profit. If you were trailing a stop, so this is my first disclaimer or my second disclaimer, if you were trailing your stop, you might find that you then maybe got to break even instead of profitable, even though the market clearly might have gone in your favor. So we might have got stopped out here, so we got that as profit. And that's not really what I'm including here. I'm saying that, look, there's definitely enough of a market move. So if you just closed out after the first or second or third day, you'd have captured profit. Okay, so that's why I say if you nitpick, it's a question of how much profit, but I want to define these as there were market moves, the signals are relatively clear, and there was profit to be captured. The next thing would be, so that would be the signals on entry. So there's signal candles, and then there are breakouts. Okay, so for example, this is a buy breakout. We can see there's a bit of a flat level and a breakout. It fails because after it's broken out, it immediately comes back. So I argue that that's not really worthwhile. Then we, for example, have got a breakout south here, which actually comes back and retests that and captures it. So there's variations on the same idea. For the newer traders, it's going to be very complex to go through this, but for more seasoned traders, you'll be like, oh, that's a signal that I might even actually miss. And absolutely, for very advanced or seasoned candlestick traders, you might say, well, that was a there were more reasons why they would take a trade or why they wouldn't take it. But this should capture most of the most agreed kind of trades out there. So let's talk about what actually happened here. If we start off in January, we had a failed breakout because we just that was the end of the move. Then we came down, we then had a bit of a consolidation and a bit of a breakout. But this, if you really know your candlesticks, this is basically a breakout and a retest. So that is a bearish breakout and a move to the downside. So I believe because of that move, I think that was worthwhile capturing. and I qualify that. Then we come back up to test this level. We do definitely have a break. We've broken this uptrend here on the left hand side. We're in an uptrend there. We've come back. We've broken those lows. In fact, we're back down here. If I put a level in there, we're at that level. We actually breach it here. We go back down. We come back up and we produce a lower high. So there are some sell signals there within this move as a move to the downside. Also, we get that level here. We break that. We continue down. So in other words, at every point where there's a bit of a pullback, there's an opportunity to sell. And I've qualified those. So if you were literally just trailing an entry below the candles, when it eventually resumed the move, you'd be in on a trade effectively. So I actually could have put a box around that one as well. Then we have a move. We're still in a downtrend at this point. The market comes back up actually here. You might have seen that as potentially a sell. You would have been stopped out, but actually coming back up to this level. And this is where it gets really tricky as well because of the different trading styles. Predominantly, we want to be trading with the trend. But sometimes price will come back up to a level to test it again and continue down. So it's for most people who follow really strong trends, this would be considered too deep a pullback because it's coming back to a level. But the fact of the matter is that it does come back to the same level and it produces a bearish sell signal. The problem is it does a single move down and then it reverts. So there's some profit captured there, but it's not a fantastic trade. However, when it does come back here, back up to the same level, it produces a really strong bearish rejection candle and then a very, very nice move. And even on the way down, there's a small pullback here. There's a continuation candle and that looks really good. And I'm going to go right up to where we are today at the point of filming this video. Then we pull back up. We've got the same thing. We've got lower highs, lower lows. We've broken these lows. So therefore, we're still bearish. We come back up, produce a bearish candle, would continue down. So yes, that's fine. We in fact do not break the high of that. So if it came back up, you would still be in this trade all the way down here. And at the same time, there's actually another double top. This is a double top rejection and a continuation down. There's also a flat level here and a breakthrough of that flat level. So there's 3 trades in this area that different traders would potentially get in on, and it continues down. It's actually a really nice move there. Then price comes back up and there's a bullish consolidation breakout pattern here. We're still technically in a downtrend. So if we had consolidated here and broken below here, we'd have resumed the downtrend. However, it's a bullish build-up and a breakout here. And so I consider that a pretty obvious build-up and a breakout to that side. And again, we have another breakout here that looks good. But where it gets really nice is we come back and retest this and carry on up. So that is a retest and a continuation. And here is a little bit of this price action is quite bullish. It's a continuation. So after a bullish move, if you get some small consolidated bullish candles, it's likely to do a further move to the upside. But it's not a great one. Again, it's very similar to the failed one up here. It's a breakout, immediately comes back. So therefore, I've qualified that as a failed breakout. At this point, we're still bullish. We've gone from this downtrend to this uptrend. We come back, we retest. This is that same one. We had a breakout and a retest and a buy. We come back and we retest it again. So therefore, traders who trade off buy support resistance levels would certainly have considered that. Okay, in this pullback, if you were trailing a buy entry, a buy stop above these candles with the idea that if price resumed, you would eventually have got triggered in here anyway. So it's the same idea. Within an uptrend, we'd be looking for buys. Price continues up here, comes back up to this level, pulls back, and there's a spinning top. It's actually really more of a doji or an indecision candle, whichever way you want to call it, but it's an indecision, it's a turning point, and therefore that qualifies as a buy signal to the upside. And that's really good. Then this is where it gets a bit tricky. So what you want, ideally in a trend, you want a clear pullback to get in as a buy. And in a downtrend, you want a clear retracement to get in on a sell. What happens here is a consolidation sideways, maybe a bit of a breakout that fails, pulls back here, bit of a bullish candle. So in other words, you've got a move up and a pullback, and it fails. So it doesn't matter whether you try on this breakout or you try on this, it's a failure. But then you get a lower high here. So there's no doubt that by the time price has got to this bearish breakout candle, that you have a lower high and actually a lower low, which means this uptrend is done, and actually that's almost a double top. So you should be considering that either you're in a consolidation and it's going to carry on out, or it's now a downtrend. It's not an uptrend anymore at this time. So what actually happens is price pulls in, you get a series of bearish candles here, which are also another lower high. So high, low, lower high, lower low, lower high with lots of exhaustion, rejection candles. And and then it breaks down. So therefore I qualify that as a sell signal. We didn't know what the outcome was going to be, but it is, as in how profitable it would be, but it is a bearish signal. So then it moves down. There's a consolidation, nice breakout candle. So if you do know breakout candles, momentum candles, you'll recognize this. And actually there was a little bit of a pullback and an indecision candle and then a continuation. So those are two separate types of signals that different traders would see. Now, believe it or not, it's hard to see all the different signals in real time. The daily would give you time to slowly digest this. But if this was happening on a 5-minute, you might spot the indecision candle. And then as the breakout candle is happening, you're like, oh, it's a breakout candle. So you wouldn't necessarily, because it's happening so fast, it's hard to see every pattern at the same time. I suppose as you get more experience, it does become easier. Now, this is interesting because here we get actually to a level of resistance. And we get a series of failures, and ultimately they all head lower. So unless your stop was just above this high, you might have got triggered in. No, you didn't get triggered in. So this becomes your sell. Ultimately, price goes down. There is a bit of a warning here. You can see that as we come down to this low, price pulls a bullish candle, which could be a potential move to the upside. As it happens, it produces an indecision candle and an outside bearish candle. So you might have got triggered in on this one and stopped out. But there was a second signal and then it comes down and it's not very profitable. So this is why I've used this extra. Neither of these setups were really that good. And the clue was in this candle here. Because price came back to this potential level of support and then produced a bullish candle. Most people who follow my stuff would have seen, we talk a lot about how you get this. This is almost a bullish divergence setup. Price just breaks below it, then produces a bullish candle. And I bet you if you look down, you'd have bullish divergence on this. Anyway, but then it doesn't change trend. It basically just wobbles a bit, which is why you get a messed up sell and then another bit of a messed up sell. So now what's happening is it's basically ranging. And I put a little box around here at the bottom. It's just a mess. It's not trending lower. It's breaking a low, then pulls back, breaks a low. All of this is just buyers coming in. It's basically going from this bearish move down to it doesn't know what it wants to do. It goes back up to the range, back up to that level of resistance. There is a bit of a sell signal there. There's another sell signal there. So even if you miss this one, this becomes more of a bearish, like the momentum is becoming bearish, and therefore that becomes a sell signal. Breaks below here. So now you might be going, I think every pro trader would be going, okay, I think the momentum is now back in. We're now going to continue down. It comes back up, produces a normal retracement. There's a potential sell signal that doesn't take off. Here's another one that does take off, which makes money. So that's good. And then it comes all the way back up to this level. So by this time, as a trader, you should be going, okay, I'm not sure what's going on with this trade because in a way, it's lost that bearish momentum. Here it starts going sideways, then it trends down a bit, but now it's back up at this level. And this will happen. Currencies will go back up to a major level because they're trying to decide if they're going to be able to break above it and go higher or if they're just going to continue down from there. So support resistance traders will have a direction in mind, but we'll probably go look at this level. It can come back up and test it. And really, when it comes back up at that level, then I will see how it reacts. And so there was a rejection of that level, look to sell. And in fact, that's another reason. Other traders will wait. If price has touched historically a level in the past, and I'm doing this in the mirror, and it goes away, comes back, and hasn't been here in a while, that will be their first intent will be to sell at that point. Regardless of whether they think it's going to be a long move down or a short move, they are looking to sell, especially when there's been a gap between these things. So price actually comes down. At this point, these candles here are a clue that it's very weak. Lots of failure to go higher, and there's a breakout to the downside. So there's a consolidation breakout, which is a sell, comes back down to here. This is still a sign of weakness, and actually almost any of these would be collectively, this would be a pullback and a continuation, or a bearish continuation, and a break below that becomes a breakout to the downside. So all of those are collectively very bearish signals that different traders would see as potential sell signals. Breaks down through that. So these boxes are sell breakout boxes as opposed to a candle that's a sell candle. Moves down, pulls back. So now we're back in a downtrend. So either a retracement or a breakout becomes a way to join the trend. This is a retracement, but in this case, actually, although it did technically capture a bit of profit, I don't like it because it goes down and immediately goes into a consolidation, and here we've got that level. So you could actually argue that that is kind of more there. Price then pulls back up, comes back up to this level up here, gives a few sell signals, goes down, comes back up, and then goes right down. So if your stop loss was here, you would have been triggered in, stopped out, then the market would have gone down. So there's some wild swings here. Then it kind of goes up again, tries to dip down, bullish, goes up again. This whole period is a mess. Like by this time, from here, the trend is clear. At this point, when you get in, the trend is still clear. It's around about here where we get another low and a double bottom, and it goes back up, but then it's stuck here. You're in a range. So this, you might think you're in a range when you see this reaction. So price pulls up, goes down. So that might be the top of the range because we come back up to it here. This might be the bottom of the range because we get that double bottom. You know you're in a range because it breaks out and breaks back in. So that's definitely a confirmation. By this time, you should just step away, because now what you want to do is you can become bullish if it breaks out, or bearish if it breaks down. And when does it break out? Here it breaks out, which then becomes the first semi-decent breakout opportunity there. And that continues down. The reason we get a really big move from there is because of the consolidation. We had a really long consolidation period here. It got really wacky there. So this is the point at which you knew you were now in a range. Up until then, double bottom, you don't know if it's a change in trend, but now it's a range. And that's your first breakout. Maybe an indecision candle could also be considered a continuation. So there's lots of candlestick traders looking at me now going, there's a signal, there's a signal, there's a signal. So I apologize if I've skipped something or missed something, but all the ones I have are independently at least valid ideas. But that could be another one here as a pause and go and a continuation. Here's a pullback. So that actually, again, if you were trailing a sell stop there, that would have triggered you in, or potentially there'd be another signal to that, so retest or stuff. So that's not a very, very obvious one. That's if you used a trailing entry stop. If you were waiting for a sell signal, you wouldn't have seen it. So it varies. There's a continuation down. Then we come to another level. Price then pulls up, back up to these old highs. So let's do this in real time now. How do we apply this to the current future market that we can't really see? We have price down in a downtrend. So we're looking for sells. Price comes back up to these old highs. But this candle here is in itself, by the way, not a really, it's an indecision candle. This is a news shock range candle, which is something that can happen at the beginning of like a change in trend, or I don't know what's going on. So we get this big shift in the market mood. Then it starts heading down, gets down to the bottom here near these lows, then goes all the way back up. Certainly by the time you get this candle, you know you're in a range. Because it hasn't broken higher, it's got lows, highs up here, lows up here, and it's ping-ponging all around. Here it comes back down, touches it, goes back up today, hits this level, and immediately rejects it. That's actually the dollar index hitting 95. If you go look at exactly that time, 95, it just tapped 95 at the bottom and just pinged right off it. So this is dollar reaction to that. And you can see it in other charts as well. This is real time. So this is the dollar that's really creating a lot here. And the reason why is because, don't know when you're watching this video, but right now there's concerns about tapering, and then that usually leads to dollar strength. But the dollar is overvalued naturally and needs a bit of a correction, but now it's strengthening because of tapering. So it could end up breaking out to the downside and continuing, but it's in a range. We're in a range right now, and actually this is not great for end of day traders. So how would I approach this going forwards? I need a breakout and a retest, a continuation back up to these levels, or a breakdown below that. And again, a breakout candle could be an entry opportunity, a breakdown could be an opportunity. So what I'm going to be looking for tomorrow is to see if we close near the highs. If we close near the highs tomorrow, we're then probably, or then the odds of us breaking out to the upside looks really good. Conversely, if we just close near the lows, we'll see how that goes. But yeah, a clue that we might get out would be a disregard of this rejection and completely just continuing to close higher. And as I'm watching in the market, it's just really that dollar strength is pushing hard. So the question is, will the market tomorrow just kind of continue? And then we'll look at that. So let's go back to the stats so that I can give you a summary of this. And this is just euro dollar over the last year. Okay, so here we go. This is the results for euro dollar for effectively 2021. Now, buy signal candles that generated profit where there was some profit. And so this is the thing that I really want to say is that although there was profit, it was not, I believe, the way it would have been 10 years ago. The average move used to be 2-to-1 or 3-to-1 or more. These days, it feels like it moves 1-to-1, 1.5-to-1, and then comes back. And so that's a big message to take away from this video. Buy signal candles with profit. So buy signals, which would be these kind of buy signal green ones that we would get that generated profit. 4 of those Sell signal candles with profit 18. So we clearly had more sell signals on individual candles. Buy breakouts that generated some profit. There were 2 of those. Sell breakouts were 6. So sell breakouts and sell signals produced quite a bit more. Failed buy signal candles, there was actually 1 because there just were fewer buy trades. There were both failed buy breakouts. Oh no, I lied. Sorry, failed buy breakouts, 2 failed, 2 made money. Sell signal candles with failed ones with losses, and sell breakouts that failed. So let me recap that. Buy signal candles that made money, 4. Buy signal candles that failed, 1. Buy breakouts that made money, 2. Breakouts to the upside that failed, 2. Sell candles that made profit 18, sell breakouts that made profit 6, sell candles that failed 5, and sell breakouts, none of them failed. So the winner out of this was effectively selling, and I just kind of put it together, which gives you 19 net trades, 19 net profitable trades. So that was the total, and actually 3 net buys. So selling this year as a swing trader would have been more profitable. It wouldn't have been fun. It wouldn't have been pretty. It would have been hard work. You probably would have just had to, if you probably just closed literally the end of the next day, you probably would have walked away with more profit, because after that it becomes a question of, will it reverse after the first day or second day or not? And so that's really where somebody who's watching this, who's a programmer, would be going, well, let's program it and put it in. But to go through that exercise as well is just good for me to go, okay, so I know now over the last year, I know that a seller, there were more selling opportunities. And, I know there were plenty of opportunities almost every other day, but not necessarily obvious. And so the hindsight thing is not necessarily a bad thing, because my brain is still learning pattern recognition. So if you back test manually like this, your brain starts to recognize stuff in real time as it's happening. It goes, that looks like that's going to break out, so that looks like a good sell signal. But it's a really good exercise to go do this. So that would have been, I would recommend, that whole process didn't take me very long, probably an hour to 2 hours, but I would do that on every single major of the kind of 47 major pairs, so that I could be able to come back and go, okay, Euro was the worst. Euro, maybe yen pairs were phenomenal. Crude oil was really good. Gold, so on and so forth. Especially gold and silver, because people love those and they're not always great to trade. For trend-based traders. For price action-based traders, they're fine. So there we go. I'm going to leave you this. I'd be very interested in your feedback. Please give me some feedback on that. I'm interested to know your thoughts on that. So thank you very much. Thanks. And hope you enjoy the video.